In 2023, the single most streamed thing on American television had been canceled 4 years earlier. Suits, a legal drama that shot its last scene in 2019, ran up 57.7 billion minutes of streaming in a year when nobody was making a new episode of it. Nobody premiered it, marketed it, or called the cast back to set, and by Nielsen's count, it still outwatched almost everything Hollywood actually released that year. One dead show near the top would be a curiosity. The fact that library titles took every top 10 spot is the business itself. And if you had the money to buy a movie studio, the red carpet out front would be the least of what you were paying for. Most of the value would be the reruns of a dead show machine humming in the basement. Walk the building the way an owner would, floor by floor, and you can trace where the profit actually collects. Start in the fantasy, because it's a good one. You greenlight the projects. You're the person who says yes to the next Barbie, who takes the meeting, who owns the lot with your name on the water tower. A modest stake runs 8 or 9 figures. Owning a studio outright runs anywhere from 9 figures for a distressed library to 11 for a major with the empire attached. On paper, the fantasy looks like a factory that makes hit movies. It isn't. What you'd actually be buying is 2 businesses stacked on top of each other. A library that collects rent for 50 years, and a portfolio engineered to survive its own flops. The new film that gets all the attention is closer to a marketing event that mints the asset than the asset itself. The numbers say so plainly. In fiscal 2024, the year that ended September 28th, Disney's actual make-and-release films line, the one labeled Content Sales, Licensing, and Other, earned $328 million of operating income on $7.718 billion of revenue. That's an operating margin of about 4.2%. Your corner grocery store does better than that. Look at what those movies feed. Disney's Experiences segment, the parks and the licensed merchandise, earned $9.272 billion on $34.151 billion the same year, a margin near 27%. To be precise, that 4.2% is one specific line inside a $91.361 billion company, not Disney's margin as a whole, and not even the whole entertainment segment, which bundles streaming and television, and cleared $3.923 billion on $41.186 billion. But the shape is the whole point. The making of the films barely breaks even, while the parks and merchandise those films feed carry almost all of the profit. Owning that machine starts at one of 2 doors, and it matters which you mean by studio, because the word covers both the company that finances and distributes films and the physical lot with the sound stages. Take the company. At the bottom of the ladder sits a distressed name and its film library, the Weinstein Company's assets, including a 277 film catalog sold to Lantern Capital for about $289 million in a deal that closed in July 2018. Upper rung, a prestige mini-major, A24 was valued at roughly $3.5 billion in 2024, an estimate built around a reported $75 million investment from Thrive Capital. A full major runs around $8 billion, the price Amazon paid for MGM, and, near enough, what the Skydance Paramount merger was worth when it closed in August 2025. About $2.4 billion to buy out the controlling shareholder, $4.5 billion toward the stock and cash merger, and $1.5 billion of fresh capital onto the balance sheet, which is a useful reminder that the headline price and the check any single seller cashes are rarely the same number, and a major with the whole empire attached. Disney bought 21st Century Fox for $71.3 billion in 2019. The other door is to become a studio one bet at a time, which is its own fortune. A single wide-release tentpole runs somewhere between $350 and $500 million before a ticket is sold. If instead you mean the physical lot, the sound stages and the real estate, you're buying a different risk entirely, a demand cliff. Los Angeles soundstage occupancy ran at 93.5% from 2016 through 2022. Then fell to a roughly 63% annual average in 2024 and about 62% in the first half of 2025, even as the county's capacity kept climbing past 8 million square feet. The stages don't stop costing money when the productions stop coming, which is the rule that governs the whole building. The costs are fixed, the revenue is not. Consider where $500 million goes before opening night. The cleanest itemized answer on record is The Marvels from 2023, as reconstructed by Forbes. Roughly $270 million to produce, though other outlets put the production as low as $220 million. Then $110 million to market it. Then $21 million in residuals and distribution. Then $54 million in pure interest and overhead, money owed on the borrowing, whether the film opens to $200 million or $20 million. Added up, and the studio owed about $455 million before the lights went down. That marketing line is the part people forget. Across one analysis of 29 blockbusters over $100 million, average production ran $150.6 million, and average marketing ran about $121 million. A second budget, nearly as large as the first, that you never recoup directly, and that is spent to sell a product before you know whether anyone wants it. And the fantasy skips the hardest part. You don't keep the ticket. The famous line that a studio keeps 90% of the ticket is close to a myth. That 90% applies only to box office above the theater's fixed operating cost, only in the opening week, and it slides fast toward 30% as the run goes on. Blended across a full release, the studio banks something like 45 to 50% domestically and less overseas, closer to 25% in China. So the gross headline is largely a vanity number. What the studio actually collects, the film rentals, is the figure that pays the bills. Which is why a film generally has to gross 2 to 2.5 times its production budget just to break even. The cinemas keep about half, and the marketing spend roughly equals the cost of making the thing. This is a concentration business, and that is the real danger in it. You'll hear that 80% of films lose money. That figure is disputed. On a large enough sample, per-title profitability is closer to a coin flip, somewhere around half. In Stephen Follow's film profitability datasets, the top 6% of films generate roughly 49% of all the profit the industry makes. A small number of titles carry the entire business, and none of them can be reliably picked in advance. You survive that only if you run a slate, and the studios that forget it die in a very particular way. Carolco Pictures was a real success. It made Rambo and Terminator 2, the first film with a $100 million budget, which grossed around $500 million worldwide, and it made Basic Instinct. But it ran on foreign pre-sales, a financing model that needed a constant supply of star-driven blockbusters to service its debt, each film effectively covering the last one's shortfall. Then came a pirate movie, whose budget swelled from about $60 million to $92 million, while it grossed roughly $16 to $18 million worldwide. Carolco filed for Chapter 11 in November 1995, weeks before that film even reached theaters. The debt is what killed it. The picture was only the last bill. The $147 million loss often quoted for that film is an inflation-adjusted number, and the loss at the time was smaller. The same pattern took down MGM, which went into bankruptcy in 2010 under about $4 billion of debt. Debt piled on a slate that lives or dies on hits is what actually breaks these companies. Which is exactly why the library matters more than any single release. A film earns in windows, and each window is quieter and higher margin than the last. Theatrical is the loss leader, the marketing event that gets everyone's attention. Then home entertainment and digital rental, where the studio keeps around 70% of the transaction at almost no added cost. Then the pay-one and streaming license, close to pure rent on something already made and paid for. Then free television. And at the top, merchandising, where the studio rents out the character and collects a royalty while somebody else makes the toy. The library is the annuity underneath all of it. When the big streaming deals landed around 2019, The Office licensed for roughly $500 million, Friends for $425 million, Seinfeld for more than $500 million, all multi-year deals, mostly US rights, hundreds of millions apiece for shows that had stopped filming years before. That is what Suits was doing at the top of 2023, the annuity made visible on a leaderboard. And there are two ways to own an annuity like it. You can build the pipe, the way Disney and Warner run their own streaming services and keep the library in-house. Or you can sell the ammunition. Sony runs no major streaming service of its own and instead rents its library to everyone else, striking around $3 billion across 2 licensing deals in 2021 at nearly 100% margin and no platform spending at all. At the very top of the building sits the merchandising royalty. Disney was the world's #1 licensor in 2021, with $56.2 billion in retail sales of licensed goods. The studio's royalty is only a slice of that number, but it is the highest margin slice in the entire building, because the studio spends almost nothing to earn it. Star Wars, bought as part of Lucasfilm for $4 billion in 2012, is estimated to have generated around $46.7 billion in lifetime franchise value, most of it merchandise, off a purchase price the movies had already justified on their own. Set 2 films beside each other, and the reason the vault beats the hit gets concrete. John Carter, in 2012, grossed about $284 million worldwide, roughly what it cost in cash, and still forced Disney into a $200 million write-down and a warned quarterly operating loss of $80 to $120 million, because the gross was never what the studio kept. The library, meanwhile, saves the company its flops can't. MGM went bankrupt in 2010 and was still worth $8.45 billion to Amazon in 2022, bought for The Vault, the Bond and Rocky franchises, and a catalog of about 4,000 films. 3 years later, Amazon paid an estimated $1 billion more just for creative control of Bond. The catalog kept paying long after every bomb inside it was forgotten. The person who understood this best built a whole studio on capping the downside. Jason Blum runs Blumhouse on one rule: keep the original films at roughly $5 million or less, so no single miss can sink the company. Paranormal Activity in 2007 cost about $15,000 to shoot and grossed around $194 million worldwide. On that model, Blumhouse has crossed $5 billion in cumulative box office. He isn't picking more winners than everyone else in the room. He's making his losers so cheap they can't hurt him, which is the same portfolio logic the majors run, drawn in miniature. Put real numbers to a single film, as an illustrative model built from verified averages rather than any studio's audited books. Say you make one wide-release tentpole, $150 million to produce, $120 million in prints and advertising, $270 million all in, and you keep about 45% of the worldwide gross as rentals. In a good year, the film does $700 million worldwide, a little over 4.5 times its budget. Your 45% is about $315 million. Take off the $120 million of marketing and the $150 million it cost to make, and theatrical alone clears around $45 million. Then the quiet windows stack on top over the next few years, another $150 to $250 million, before the leak on the way out, the talent's profit participations, which take roughly 9% of the income on a hit. Net it out, and you're up somewhere between $150 and $250 million, and you own a new franchise that keeps paying rent. That is the shape of Barbie. It grossed $1.447 billion worldwide in 2023, on about $145 million of production. Deadline modeled a net profit near $421 million for Warner Brothers, and about $350 million of that came from home entertainment, and TV and streaming stacked on top of the theatrical run. In that case, the back windows delivered the larger half of the return. Take that same $270 million film into a bad year, and it limps to $180 million worldwide. Your 45% is about $80 million, which doesn't even cover the marketing, so you're $40 million down before you count the cost of making it. Add that back, and you're staring at a theatrical loss near $190 million. The back windows might recover $60 to $100 million. They never fill the hole. And the participations don't disappear just because the film lost money. Even loss-making films still pay out around 5% of income to talent. Net, a write-down of $100 to $150 million. That's John Carter. That's The Marvels, which grossed $206.1 million in 2023, against that $455 million cost stack, for an estimated loss around $237 million. What turns this from a gamble into a business is the arithmetic between the 2 years. One good year film, up near $250 million with a franchise attached, pays for 2 or 3 bad year films held to $100 million each, so a single Barbie more than covers a Marvels. Owning a studio, then, is the work of managing a portfolio around the vault, and the studios that die, like Carolco in 1995, are the ones that bet the whole company on a single film instead of running the slate. Suits going to #1 4 years after cancellation looks like a nostalgia story. What it really shows is the vault earning, quietly, long after the premiere that paid to build it. That premiere was the down payment on decades of rent. Own the studio, and you're not buying the next hit. You're buying the vault, and the discipline to keep the misses small enough that it outlives them.